Thank you so much, Tina, for that. And now next we are talking to both Hugh Karp and Dan from the wonderful world of insurance and blockchain. Hugh, why don't you give us a quick introduction to yourself before we kick off?
Yeah, thanks, Alex. Yeah, my name's Hugh Karp. I'm the founder of Nexus Mutual, and we are a decentralized alternative to insurance. And our goal is to really be a blockchain-based Lloyd's of London. Anyone should be able to bring any risk to us, and we should be able to cover it. That's our goal in the future, starting with crypto risks for now.
Awesome. And Dan, over to you, sir. Love to get an intro from you.
Sure, yeah. Thanks for having us. Name's Dan Roberts, CEO of Nayms. We're looking to sort of on a similar ilk to Hugh, use smart contracts as a means of providing the rules for risk placement, but risk trade, reporting, claiming, and settlement. So focusing on the sort of entire life cycle of a contract. You know, we sort of feel native to the crypto space. So like Hugh, focusing on digital assets, and particularly that kind of bridge between you know, capital markets and this sort of new, exciting, emerging risk category.
Awesome, thank you both. And in case you don't know who I am, which is most likely, it's Alex Batlin, founder and CEO of Trustology. We are a custodian wallet provider, mostly focused on B2B clients. So we work with guys like brokers, exchanges, and funds, helping them to manage their assets, their client assets, as well as DeFi transactions. Great, perhaps if I'll start with Hugh. Can you talk about what you believe the problem statement is, and then kind of what customer segments you're looking to address with the solutions you're kind of providing?
Yeah, thanks, Alex. So I think we're trying to build a generalized platform that can cover any type of risk, but we've specifically focused on smart contracts risk to start with, mainly because we saw things like the DAO Hack, the parity multi-sig qualities, and other big events. And we thought if Ethereum and the decentralized ecosystem is going to develop, then it's going to need insurance type solutions to cover that risk. Otherwise it just won't be adopted. As with any kind of new economy, you kind of need basic financial infrastructure, and insurance is kind of part of that. So that's kind of what we're going for. There's always going to be this question when you code something, and code is supposedly law. Code is never really law, but you know, the code operates as you write it. Then like, so is that a bug or is it not a bug? And kind of the way we've kind of described things with smart contract cover with Nexus is, if it was clearly against the intentions of what the developers were writing, then we should pay a claim. And in most circumstances, it's going to be pretty easy to determine that. Like if a whole bunch of money gets drained out of something, because there was a check that was supposed to be there and it didn't work or something like that, then that should result in a claim. But the only real way to kind of assess if that's happened is actually put humans in the process to kind of assess that and have some judgment involved, which is kind of a bit strange in our whole programmatic world of DeFi, but having that approach actually gives us a lot of flexibility. So that's the way kind of Nexus works, with a group of people voting on the claims to determine what's legitimate.
I guess that's the point of the mutual part of Nexus. So you have a bunch of people reviewing failure modes and basically voting for or against that. So what happens, you know, kind of how do people kind of, how do you avoid people voting the wrong way, kind of?
Yeah, I mean, it's an obvious question, kind of like the alignment of interest type thing. I guess there's two kind of real key mechanics there. One is you have to stake as part of the claims assessment process. And there has to be a lot of stake, like kind of a minimum of 5 times the amount of cover that's being approved in stake has to be there. So there has to be a large chunk of stake to approve a claim. And the first thing is, if the mutual was to decline all valid claims, then it would have no value. And so the people who are staking essentially would have to stake in NXM tokens, and they would drop in value substantially. So that's kind of like a higher level incentive. And then we have a specific incentive, which is kind of lower level. And that's where it's a bit more centralized right now, but that's where we have a group of people that can only punish, they can punish the claims assessors if there's clear attacking of the system. And that's kind of a good threat to just prevent things from going awry. And we've done a lot of like simulated based modeling and AI agents kind of bribing each other and stuff like that to try and extract money from the system. And it holds up pretty well. But, you know, nothing's better than a real world case. So we're kind of, you know, experimenting with it still and looking to harden it over time.
Dan, thank you waiting so patiently. I'd love to take your, you know, what's your angle, who are you selling to, and what's the value proposition?
Sure. So I guess we are probably starting with a more general approach. So the problem we came across right at the beginning of our research was huge amount of emerging risk across all sorts of different categories. Smart contract risk being one of them. And poses a big opportunity for the brokers and for the underwriters, more in the traditional space. And there seemed to be a growing amount of not just the big brokers in the market, sort of Aons and Marshes, but the the sort of growing grassroots brokers that were coming out of the woodwork specific to serve this new area of risk. They all had their different take on their different products. How they were both mitigating risk and covering it, and they had their own approach to carriers and syndicates to cover that. But we just, some kind of napkin calculations saw that if you're constantly using traditional capital or sort of dollar-based capital to cover the liabilities, then you're going to hit a scaling issue. So at the lower levels of the market, you probably, you'll be okay. There's capital in the billions that's written for all sorts of different types, mainly cold storage and some sort of quote unquote safer risks. But if the space is really going to grow as we're all expecting, then you need the infrastructure and sort of capital that will scale alongside that growth. So the low end billions will be completely insufficient. There's always going to be this sort of asset liability mismatch of dollars covering big Bitcoin loss or an Ether loss that feeds into pricing problems, caps in dollar values, meaning that capital is technically underexposed or overexposed. So we started more by focusing on what was the needs of the brokers, how could the brokers source efficient capital, and we came to the conclusion really that this kind of insurance problem, it's going to be a collaboration. So we're excited to work with the likes of those on the call, but it'll be a collaboration between the underwriters and brokers and capital markets. We've taken a sort of more regulated approach to that by essentially saying the underwriters and actuaries, etc., in the space that can assess all sorts of different types of risk. Not focusing on one necessarily, and we certainly don't dictate the exact nature of what that risk might be, will really be the gateway to bridging the sort of capital markets and crypto native capital markets to begin with into all sorts of different types of risk.
So it sounds like the kind of so what kind of covers do you focus on? What types of risk are you looking to cover?
So I mean, in terms of roadmap, we've got a cohort 1 that we're running November, December this year, and then a cohort 2 that we're aiming for sort of March, April, before a full license next May. And they're both within sort of a sandbox license. So 6 contracts, I would say 5 of them are in the digital asset space. We're looking at some tech E&O, so tech errors and omissions for that is currently the way that brokers are seeing smart contract cover, and all the way down to the sort of safer cold storage reinsurance for some captives and things like that.
So it sounds like you guys are quite compatible. The problem that you're solving for is really the underlying capital base, because kind of if you're insuring crypto with fiat, the problem is you have an FX risk. By making sure that you effectively write the policy in crypto rather than fiat, you mitigate that risk and you're focusing on the reinsurance. whilst I guess kind of the problem that is being solved by Nexus Mutual is kind of providing a new type of product, which is kind of smart contract risk, and the two can be combined together. I guess that's pretty exciting stuff. So in terms of, part of the beauty of the blockchain is it's a platform. So it allows both people to gain some value by purchasing cover, but it also allows investment opportunities for people to participate. So I'd love to understand a little bit about, in both of your cases, the kind of the supply side and the benefits of people contributing to your protocols, so that people understand both the benefit of buying the product, but also contributing to the pool. So perhaps, Hugh, why don't we start with you, sir?
Yeah, so there's basically all members in our mutual share risk together in some way, shape or form. That's the idea. And so we've got, there's a variety of functions that you can perform, and you can perform like one or all of these if you'd like. And so the most obvious one is like you can buy cover and get some protection. Then you can also get involved in staking, which is kind of risk assessment. So you kind of back specific risks or smart contracts that you think are secure, and you earn rewards when someone buys cover on them. And so that's kind of like a specific, you share in the risk of the whole pool bit by the nature of just owning a native token, and then you kind of double down your risk on specific risks that you want to back, so specific smart contracts that you want to back in return for enhanced rewards. And so that's kind of one thing. You can also vote in governance, and you can also vote in claims assessment. And so I guess by nature of those things, you can, there are a whole bunch of things that you can do, and there are ways to, I guess some people might want to do some of those, and other people might not want to do all of them. And so, I guess things like your platform is an example of, being able to, if institutions want to get involved and want to restrict a particular access on different aspects, that could help. So yeah, there's quite a lot of things you can do, and but you can do any and all of them, and there are quite a lot of, I guess, rewards involved. Our main goal is to provide the platform to coordinate everyone, and the incentive mechanism to coordinate everyone, and for outside work from the members to be provided to run the whole system where it needs people. So automate whatever we can, and then incentivize people to provide the work where we can't.
What benefits do you kind of offer to the supply side in your system?
Yeah, so it's along the lines of what I was saying earlier, is really just seeing a regulated underwriter as a gateway to the capital market piece, and the technology really lends itself to just easing that process. So we have two general phases. The first one, as I mentioned, is this kind of collateralized piece, where essentially a capital market provider, institutional investor, is backing a specific type of risk, a kind of one-off cover for a year. It's a custodian, it's X, Y, and Z. The contract is still being created by an underwriter. It's still being sort of fairly priced. Fairly priced as the initial placement.
Yep.
Kind of like an IPO. And we've structured it along the lines of an ILS contract. So insurance-linked securities, it's a fully collateralized contract that sits there for a period of a year, say. There's lots of interesting points there, and one of them is just it's predetermined for a set period of time. You get your principal plus your yield at the end of the period. If you can find a buyer within that period, then you can trade in and out of that position. But other than that, you're kind of locked in for that period. And we hope this model will spread into an industry like the ILS space, where that kind of trading in and out of positions is sort of very simple, and it's just a bid offer system that everyone's used to. And then the second phase is sort of very similar on the technical implementation, but there's obviously it's quite different, which is we just call it traditional underwriting. It's just much more traditional format, which is the role of the capital provider is to back underwriters. So primary underwriters or reinsurers. Over time, these guys will have track records on the platform. They obviously have track records off chain already that go back decades. But we see that as a again, an interesting gateway for capital markets to invest in insurance risk without, taking on any of the kind of pricing responsibilities. And we're hoping that will be an interesting model for not just the capital providers to get involved in this kind of risk. And obviously there's a variety there. Investing in an underwriter, you're essentially investing in a diversified pool anyway. But also for the underwriters to get more exposure to this without necessarily putting a huge amount of capital forward. So yeah.
So that's really, so basically what you're saying is you're tokenizing the underwriting and then potentially, you could put it on Uniswap and trade it.
Potentially, yeah.
Yeah, no, that's pretty cool. That's pretty cool, kind of, which kind of brings back liquidity to kind of a lot of folks that might have felt it was trapped and couldn't get out of it. Cool. Roadmap wise, what are your plans for the next kind of 6 to 12 months, which I know is like infinite amount of time in this space. Maybe I should just narrow it down to three months or something. But anyway, whatever that period is, you're comfortable talking about it. What is your roadmap, and what are the unique institutional challenges, especially that you're looking at? So, Dan, over to you, please. Yep.
Yeah. So, we're right on the edge of closing our seed round, so we're a little behind Nexus Mutual in that regard. We sort of set up last March. And we've just closed funding to give us 18 months. So we do have plans beyond 18 months, but we're kind of focused on that. Over the next 6 months, it's really getting these first 2 cohorts out. So we set up our 2 cohorts. The first one to be more of a kind of technical challenge, technical test. Our beta's on mainnet now, but we're sort of doing these a few private placements of contracts over cohort 1, 10K in contract limits, so they're very very small, but lots of learning there. Cohort 2 is larger limits, real cover. The outcome of these cohorts is less about technical testing and more about providing a story to the market of how this can scale post post trials. So looking around limits of that sort of 500K, 1 million mark, to kind of provide that story going forward. And then beyond that, so as I mentioned, we've got 2 sandbox licenses, and they convert to a full license next May, all going well. And that sort of next May for us is really a go time for us to gather information, teach brokers, take them through our contract builder, get them comfortable with placing more and more risk towards our Series A.
Great. And I guess the interesting thing is a lot of people don't consider it, and then when they do, they kind of talk to us, is to do all that smart contract operations on blockchain, you need private keys, you need to be able to sign transactions, and you could lose those keys. So really important that people plan through, whether it's Trustology or somebody else, how do you manage your keys? How do you manage transactions? So obviously people who are watching and wondering how that plays out in practice, we have, really good integrations with DeFi protocols like both of yours that we can help with. Dan, over to you. Plans. Love to hear what you're thinking going forward. Sorry. Hugh, apologies.
All good. Yeah, so I think a couple of things. We're kind of, we've got a lot of complicated mechanics in our model about basically getting the incentive structures right. And so we're definitely iterating on some of those things a little bit more. We're looking to revamp some of our staking to kind of make it a bit more fluid and crypto native and remove lockup periods, and basically off feedback that a whole bunch of people have told us, which is pretty strong. On the product side, we're looking to provide a more comprehensive, wider product that covers a whole bunch of risks much more easily, especially with like DeFi Legos building on top of each other. People don't quite know which systems they're exposed to, so we kind of want them to get a comprehensive cover that covers everything underneath, and so that in one go. And so we're going to be building a product on that side as well. But I think more generally, and this probably applies to this applies to us, and I think where we're going is like the institutional side of things sees insurance as one of the tick boxes before they start getting involved, and so being able to provide solutions for that type of market is kind of where we're going. And I think most of the people, most of the cover that we've written so far is primarily from those types of individuals. It's been larger cover amounts written by hedge funds or smaller institutions. And we kind of see that's where the main bigger market is for us, while also providing really slick solutions for kind of the retail-ish DeFi crowd.
At which point we will conclude, and I'll hand over back to Tina. Thank you so much for listening, and thank you for participating on the panel, Dan and Hugh.